We have a big week for the markets this week and next week with inflation reports coming out, or not next week, but first couple of weeks of September with the August inflation numbers coming out. But right now, it's all about Jackson Hole and Jay Powell. So let's take a look at a couple of things here. Markets are kind of flat, up a little bit. NASDAQ up 1%, S&P up 0.68, Dow Jones up 0.28, ahead of what's expected to be a very hawkish Jay Powell, an exact opposite of the last time he spoke, wanting to correct the mistake he made, saying that the Fed had reached neutral. And what he has to say, the markets will not want to hear. And the Fed is not happy with the increase in the market since the last time they talked. They are not happy with the decrease in interest rates in housing, in the housing market, slow to correct, although we have seen some correction, but it has been slow coming. But investors are looking for new guidance in Federal Reserve Chairman Jerome Powell's Jackson Hole, Wyoming speech Friday, but he could instead deliver the same inflation fighting message, just with a much tougher edge. And all of the Fed board members are all coming out today ahead of Jay Powell's speech tomorrow with the exact same talking points. And I'll play you some of that in a minute. But they're basically saying inflation is too hot. We're talking to our businesses, banks, and entrepreneurs in our regional markets that we run, the regional Fed chairs. And they are saying that we are seeing increased costs. We are seeing difficulty hiring and pressures on wages, which are increasing costs. And we have got to get inflation down. We are not going to lower interest rates until inflation comes down. And we are going to leave interest rates higher for a longer period of time. We are not worried about recession. We are going to get inflation under control. So the Fed has chosen inflation over a slowing economy and recession. Now, these are the board members. That's not Jay Powell. Everybody's looking for Powell, and I'll play you a video here in a minute that kind of tells you exactly the talking points that are coming out. But the challenge for Powell is going to be the tone he adopts. I think he came across as slightly too dovish, not hawkish enough in July, said David Page, head of macroeconomic research at AXA Investment Managers. I think he wants to avoid that now, with markets expecting him to be relatively hawkish. It's a very difficult game. It's a game of expectations, and it becomes a fine-tuned issue. So we want to communicate that rates are going to stay higher longer so that the markets can price that in, meaning they want to see the markets cool off. So on to other news here, and the next big news item on the front is the ETH move to proof of stake. And the big question is it going to work? Is it going to be effective? And what is the price going to do? And all of the, several of the ETH whales are and have been moving their coins onto exchanges to take profits. So the Ethereum blockchain is slated for one of the most significant updates since in its inception, as it transitions from proof of work to proof of stake. And that may take away the competitive advantage that Ethereum has right now. The move is not going to affect gas fees or anything of that right now. It might be a little deflationary for the token, but this is potentially one of those buy the rumor, sell the news events, as we've seen with Cardano, Matic, Solana, Avalanche. We've seen a lot of buy the rumor, sell the news events, Dogecoin, over the last couple of years in crypto, and more specifically in the last year. So the bullish enthusiasm in terms of token price and market sentiment seems to be on a decline as the merge nears. There have been a sharp decline in the holdings of significant number of ETH whales. Data from crypto analytics sentiment indicates that the gap between Ethereum's 10 largest non-exchange addresses and exchange addresses is closing. Over the past 3 months, top whale addresses have sent a significant amount of ETH onto the exchanges. So the flow of crypto onto exchanges generally reflects the bearish sentiment and is often done by traders taking profit by selling their tokens. So a lot of people are taking profits since ETH got back up to about $2,000 and has been on a decline ever since. And then in terms of what could go wrong with the ETH merge, no one knows what will happen immediately after ETH's merge between Bitcoin, between its beacon chain and mainnet. Some industry participants remain skeptical, believing that a lot of the price action has already taken place. Prices would likely dip should the merge be delayed in some fashion, probably crash completely, which would harken back to similar instances in Ethereum's history since its inception in 2016. Around the merge, we can expect increased volatility And given the current economic climate, prices are more tied to interest rates and inflation than they are technological advancement of Ethereum itself. So we talk a lot about global macroeconomic environment and events on this channel because it's all related. These are risk assets, regardless of the use case. Right now, these are just risk assets, and they are on the higher risk, most speculative end of risk assets, and they are liquidity driven, meaning when you're in a zero interest rate environment and the Fed is pumping trillions of dollars into the market from March of 2020 on, this is what you get. You get parabolic, all bets are off, take full on risk because there's no risk. So it's zero interest rate. The Fed's got your back. It's a Fed put, buy the dip. That's the environment we've been in. This is what a global macroeconomic risk off environment looks like. When the interview I just played that I just played for you with that Fed board member George that said we want the market to price in tightening conditions, not easing conditions. So this is what tightening conditions looks like, and then over the last couple of weeks, this is what easing conditions look like. So after Powell said we're at neutral, the market said easing conditions, and that's what this rally was all about, as well as some short covering and algorithmic formulas that if this, then that, if the Fed says this, if Powell does that, then do this, and those types of things. So right now, the markets are just kind of waiting for Powell to make his move and come out and give some clearance and some guidance in terms of what's to be expected. And we looked at this the other day, the 200-day moving average. Next up is the 100-day. So if price loses the 100-day moving average on the indexes, then there's going to likely be more significant downside and a retest of these lows. Will they hold? Will they not hold? Jim Cramer said that the lows are in, so you know what that means. Jim has been a good contra indicator in the markets here lately. The VIX is on its way back down, which is not a good sign. Remember, when the VIX is high, it's time to buy. When the VIX is low, it's time to go. So the VIX has been low at the lower ends of the market up here. This was the bottoms of the markets when the VIX is up in this area in the 40s. That's generally when you're going to see your bottoms. If you go back and look in the history, this is March of 2020 up here. How far back does the VIX go? Let's see if we can get back to 2009. There's your 2009 bottom right there. So you can see major market bottoms. When the VIX is high, it's time to buy. When the VIX is low, it's time to go sell. So we are still in the sell time frame here, waiting for the bottom. So this is not your buy signal on the VIX. The dollar is continuing its move up, has rejected here. Some people looking for this, calling a double top. If you look at the daily close, it's a higher high and looking to put a higher low in and kind of reverse. If we look at the price pattern here, in terms of how that works, you have your low, you have your lows on the range, your higher lows, higher lows, higher lows, higher lows, and onward and upward. And just like your lows, you've got your higher highs as well. Drew a little scratch there. So let's remove those. And same thing here, higher highs, higher highs, higher highs. This is a higher high when you zoom in on the close than this here, but could it be a double top? This was called a double top. This was called a double top. So we'll have to see how high could the dollar go. We haven't seen, let's put it on the weekly here. In this range right here, the next stop is 120. Some people are calling for that. That was a double top at 120, where the second top was lower, triple top actually, 1, 2, 3. That was your W, which generally is going to reverse the other way, but it didn't. It went down instead. So very difficult to call. And a lot of it depends on what the Fed does and says here over the next few days. Oil is another big one. Got to keep our eyes on oil, as the Saudis have said they're going to cut production to raise oil prices. So there's a lot of analysts calling for oil back into the $120 range. If that's the case, gas prices surge again, which is the only reason inflation was down on the last reading, was because gas prices came down. Even though they're still ridiculously high, they did come down quite a bit from $5 to national average, I think, is in the $4 range. That's still obnoxiously high. And this may get back up there again. And we have the fall and winter coming, when energy prices and demand is going to be a lot higher. So they are setting the table for more higher oil and energy prices. And right now we're still watching Bitcoin here kind of consolidating right here for the next wave down. And that's kind of what this has been. Still, now below all moving averages, lost the rejected off the 100, lost the 50. Every time that happens, when it rejects off the 100, loses the 50, it kind of drops. And you can go back into 2018 and kind of look at the time frame where these things happen. Price popped up over the 100, rejected off of it, lost the 50, went on down, popped up over the 100, rejected, lost the 50, and just kind of worked its way down. But this was the last area right here. Let's remove the moving averages because this looks a lot like, oops, wrong one. This looks a lot like where we are right now. So if you look at this little package right here, that little spot right there, kind of looks a lot like where we are right now with this little spot right here. So are we going to see the same kind of thing there? And we've been targeting that and kind of looking at that. We talked about this last little wave down. That was a big one. And I made a video the other day talking about a potential down leg of that's about a 50% move from where we're at now. Could price go lower another 50% from where we are here? Sure can. Will it? No guarantees. Not saying it will, not saying it is, but it is possible. And it's more likely that you're going to see some downside than upside. But a 50% move puts it at about 10,600. A lot of technical confluence for price to hit that level. I think obviously what's more likely is the next test to see if this 17,500 to 700 price level holds. If it does, then that could be your bottom signal right there, especially coming off of Powell's speech today, inflation print in September, and the next meeting of the Fed in September. I think once we get through that, we should be able to start talking about more of a structural longer term bottom after the market makes its move after today. So I think you've got more downside after the Fed speaks, Chair Powell speaks tomorrow. If we get a consistent inflation report in September in that 8.5 to 9% range, and then the Fed raises interest rates another 75 basis points, then I think you'll definitely see the markets price that in, which they're going to start doing tomorrow ahead of that move. And then I think after that, we could probably start looking for that more structural long-term bottom for markets to recover from if everything else stays in check. If we don't get really obscene oil prices, if we don't get any escalations in the Russia-Ukraine conflict, and if we do not get any other geopolitical issues out there, conflicts with Iran or with China, which those threats are heating up and kind of working their way onto the radar here. So those are the things I'm looking at. We'll see what happens tomorrow. I will make an update tomorrow based on what Jay Powell says, what the markets are doing, and what they're looking for. But right now, the Fed is consistent in their messaging that they're going to get inflation down no matter what. That's their number one top priority. They understand that it's baked in, that it's going to last longer than what everybody thinks, that rates are going to have to stay higher than they think. They want to see the markets price that in, meaning the markets are too high. They want to see mortgage rates go up. They want to see the housing market cool. They do not want to see bond rates dropping. They want to see bond rates increasing, meaning risk off. Crypto is risk assets. Bitcoin is a risk asset. They want to see deflation in risk assets in the housing market. So until we get some of that, the Fed's going to keep fighting. So those are the things I'm looking at. I'll see you in the next video.